Ticker symbol Yeti has been trading sideways for the past year. As you can see, it's only down 2%. And today we'll be looking at a company which has a great product with a very loyal customer base, and why this may be the perfect boring stock, as it has very solid fundamentals, improving efficiency ratios, and it operates in a sector where there is low competition and low innovation. So today we'll be looking at Yeti Holdings, a leisure equipment company. In their annual report, they describe themselves as a global designer, retailer, and distributor of innovative outdoor products such as coolers, bags, and apparel. Their product portfolio is comprised of these three categories, where they have coolers and equipment, which makes up 36% of their net sales. Then they have drinkware, which makes up 62% of their sales, and then other. As you can see on the image, this is part of their coolers and equipment category, where if you're going fishing or if you're going hiking or any other outdoor experiences, you can take this, pack all your food, all your beverage items, and anything you need to keep cool in there, and it will be safe and ready for you to consume whenever you wish. They, of course, offer these products in the United States, Canada, Australia, New Zealand, Europe, and Japan through both wholesale and direct-to-consumer channels. They say that they historically experienced the highest level of net sales in their fourth quarters, which makes a lot of sense as this coincides with the holiday shopping season, and this is a great product to give during Christmas. And one good thing to note is that the company currently has the aim of expanding internationally, and they mention that their primarily focus is in the Asian markets, where they see the greatest need and greatest demand for these type of innovative products. Now, moving on to their financial analysis, we can see that their return on capital employed is fantastic at a 17%, which is above the 15% threshold that we usually look for in this channel. Then they have a very solid interest coverage ratio of 240 times, meaning that they won't have to worry about debt anytime soon, and they have a very good cash conversion of 125%. Their profit margin is great, sitting at 57%, and their operating margin came in at 14%, which is right where our threshold of 15% is, so we will give that a pass as well. And now this company did have a rough 2023, as we can see their net margin was actually below what it had been, and in 2022 it had been trading downwards. However, now that has recovered in 2024, and the revenue has been increasing at a pretty stable rate. As a result, as the efficiency ratios are very closely linked to net income, these have also done better in Q4 2023 and Q1 2024, where the return on invested capital, which is the ratio that we should focus on from this slide, actually came in close to 45 times, which is very good. And the fact is that Yeti is sitting in a very stable position. As we can see in 2016, its total liabilities were above its total assets, and as I've said a lot of times in this channel, I'm not a big fan of a company having negative equity, as to me it's sort of a red flag. However, throughout the years, they have managed to fix this issue, and right now they're sitting at a current ratio of 2.5 times, and it means that it won't have to worry about debt anytime in the near future. Now, Yeti gets a 6 out of 8 when conducting the fundamental analysis, as first of all, it has low liability risk, as we saw at the start, where it actually has an interest coverage ratio of above 200 times. Next, it has a very solid balance sheet, as it is able to cover all of its short-term liabilities only with their current assets, which I believe are 3 times those of their short-term liabilities. Now, this company does conduct share buybacks, and although it does not pay a dividend, this share buyback program is great as it rewards investors by increasing the value of their shares. Then this company actually manages to grow their revenue organically, as we have been able to see, and what this means is that they don't rely on buying other companies or on M&A to actually grow their revenues. And finally, I believe that the most important ticks that a company should have is their pricing power and their existing moat or competitive advantage. This comes from the fact that there are no other products like the ones that Yeti offers, as the founders developed these when they spotted a gap in the market that nobody else was covering. And they actually developed some patents for their products and are experiencing great growth and great profitability from them. However, I do believe that this moat or competitive advantage is not as strong as other companies that we have reviewed in the past, because although their product is great and nobody else is doing the same, I don't think it's a very complicated product to actually manufacture, and in the near future, there is a big threat of other competitors actually entering the space and creating similar products or even innovating in the space and taking market share away from Yeti. So that's always something we need to keep in the back of our minds. Then the two things that I did not like from the fundamental analysis was, first one, that their free cash flow is not growing organically. Although their revenue is growing, their free cash flow is all over the place, which also affects the fact that their free cash flow is not consistent. One quarter they're having very positive free cash flow, the next quarter it's negative, and it's all over the place, which is something that we don't like in this YouTube channel. But now when moving on to their valuation analysis, we can see that this company may be trading at a discount when actually looking at the PE ratio. Why? Well, because it is currently trading at a PE ratio of around 18 times, when the average for the past 4 years actually looks like it has been trading at an average of 13 PE ratio. However, we do have to keep in mind that this company was projected a way higher growth rate than it is projected right now. But this is actually in line with the fact that it also looks undervalued when looking at the free cash flow yield, as this company yields a 7.15% compared with the 3% long-term inflation rate. Now, the two biggest risks and possible challenges that I do see is, first of all, the worsening competitive landscape. As I spoke about previously, I do not believe that this is a very hard to make product that does not drive recurring revenue, and it does not force your customers to actually pay a subscription. So if another competitor comes in with a revolutionary product or just imitating the one that you have but at a lower price, I don't know what customers will just not buy from the other competitors. And the second big risk is the risk for an economic downturn or cyclicality risk. Now, although I do not believe that there will be an economic downturn anytime soon, I do believe that the demand for these products is actually kind of cyclical, as they're mainly for tourism, or it can actually be driven by the hype of this product being extremely new to the market. And this company will have to develop new product in order to keep the demand going and to keep the revenues rising. So before we move on, please remember, I'm not a financial advisor and this is not financial advice, so please do your own due diligence. I do believe that this company has a competitive advantage and it has high return on capital employed, meaning that it knows how to create value for the investor. However, the fact that it does not have consistent, nor predictable, nor growing cash flows makes me want to stay away from it for the time being. But I do believe that this is a good company and may be a good investment despite not having very great cash flows. So thank you for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content, and there is a link in bio for free stock if you join Trade Republic.